The syllabus has 5 units. The first one talks about the strategic planning and control. So what is strategic planning? What's the process, etc.? We would be looking into that. The second one is about risk and uncertainty. What is the impact of risk and uncertainty? Third says performance measurement, information systems and development and technology. Not a very big one, but some important aspects about information technology we will be learning here. Fourth section is strategic performance measurement. How performance is measured. Then the last one is about performance evaluation and corporate failure. Broad classification is done in these 5 sections. Topics may not flow in the same pattern. Some of them, something related to corporate failure can be done before strategic performance measurement or something like that. But overall, we see that there are 5 sections. According to Kaplan, the syllabus is spread over 14 chapters. Okay. As part of strategic planning and control, if you look into that, the gist of it, I'll just explain to you. As part of strategic planning, first thing what is done is what is that it is possible for them to achieve will be assessed. When an organization is established, the organization would be established with some basic purpose. So there is a purpose why any organization is established, be it a profit-seeking organization or not-for-profit organization, whatever it is, there would be some purpose behind establishing an organization. So the purpose is defined in mission statement. So the mission explains why is this organization established, what is that they want to achieve. So we can put this one as desired performance. Later on, before the plan is prepared, then they would also assess what is possible for them to achieve. So how do they assess that? We will see that. How do they assess that? Will is they would understand what is the expected performance. What is that it is expected to achieve? See, given the set of possibilities and uncertainties what they have, what is possible to be achieved. So if both of them match with each other, there is no issue. If they do not match with each other, if they are not equal, then we see that there are certain strategies which are taken up to see that they both match with each other, or if at all, if there is a gap between that, that gap can be closed. So, I mean, basically, that is the gist what we will be looking into as part of strategic planning. So strategic planning, planning which is taken up by the strategic level of management in the organization, which can be achieved over a very long period of time. It is not a simple thing as which can be applied and achieved in a short period of time. A very long period of time, which involves the entire organization and the planning that is taken up to ensure that whatever is the purpose for which the organization is established, that could be achieved. Okay. So as part of that, theoretically, conceptual wise, we will be running through that. Since 2 sessions were already done, maybe initially I will just take you through these topics little at a faster pace. After that, we'll settle down and then we'll slow down. Okay. Like I just mentioned that the mission talks about the reason, the purpose why it is existing. Then we see that in an organization, there are 3 levels of management. In the hierarchy of the organization, there are 3 different levels. So we see that this is the first level, the strategic level, the second one, middle level or the tactical level, the third one is the operational level. Now, when planning is taken up by these 3 levels, each of them has a specific purpose of planning. What is that they would be planning? If we look into that, the strategic planning, the strategic level, basically all 3 levels of levels of management would be working towards achievement of the basic purpose of the organization. So we see that. I'll take you to the next slide. We see that the mission statement outlines the broad direction of the organization, its reasons for existing, and its values. Coming to the strategic level, we also call it as the top level management. So when they are involved in planning, what is that they are involved with? See, they plan for the entire organization as a whole. So the planning involves the entire organization as to what are the products and services they would be producing and selling, what are the markets in which they would be present. See, it is about the entire organization. There is no in detail, intricate planning taken up, but at a broader level, the planning is about what is that they would be achieving, what products and services would be sold, then made and sold. Then comes the markets in which they would be present, domestic, international, venture into newer markets, etc. Then we also see that how would they want to grow at a um, incremental pace, slow and steady, or take dynamic decisions, radical decisions, and then quickly achieve growth. So that kind of decisions are taken by the strategic level. What do they plan? For how long do they plan? Their planning involves a very long period of time. See, those things cannot be achieved in a short period of time. So planning for a very long period of time for the entire organization. So undertaken by senior managers, it involves making long-term decisions for the entire organization. Decisions like products and services to be produced and sold, markets in which they will be present. Will they think about growing at a slower pace or incremental pace, or dynamically they can think about the growing, that is join with some other business leader, joint venture, or they can think about acquiring another business like acquisitions, etc. So these are all decisions which involve the entire organization. It is not specific to any particular department. It involves the entire organization. Middle level, we have many terms used for this level. Middle level, tactical level, of management level, functional level. These are all the terms which are used. You are aware of all these things. The middle level management is also involved in planning, which is done intricately about what is the role of each department division. Then the planning involves about what work has to be assigned to the departments, individuals, how would the resources be allocated, how is the planning taken up for the future, etc. So the planning is in detail, very specifically related to people, departments, divisions, etc., and how the resources are allocated. So that is the kind of planning taken up by tactical level. Undertaken by the middle management, it tends to look at plans for specific divisions, departments, etc. And how would they be using the or allocating the resources so that it can be the purpose can be achieved. Operational level people are the ones who are actually implement the plans prepared by the top management and the middle management. So they implement that. So implementation is carried out by the operational level. They are implementing it, but they also require some amount of planning, maybe day-to-day implementation at that point of time, something which is required intricately to look into that. So that is in detail planning, very specific to their work, the nature of work which they are involved with. So they would not be involving a department, division, or the organization, but for them to be useful day to day, very short period of time, such kind of and planning which is useful for the such kind of periods is taken up by the operational level, undertaken by junior managers and supervisors. It is short term, detailed, and practical. So now 3 levels of management. See, all of them are involved in planning. They plan for the organization. And after planning for the organization, then we see that what is possible for them to achieve is what has to be assessed. Like I mentioned some time back, that see what is the desire. Desire is given by the mission, what they want to achieve. What is possible for them to achieve is expected. So when they both are compared, they have to match with each other. If they do not, then there is a gap. But then how do they arrive at this expected performance? How do they know what is possible for them to achieve that? There are three different types of analysis taken up. One is an external analysis, internal analysis, stakeholder analysis. You are aware of what is the concept of SWOT, SWOT. All of you are aware of what is SWOT. See, S talks about strengths, W weaknesses, O opportunities, and T is threats. So these two are internal factors. O and T are external factors. Strengths talk about what is the organization good at, what is their strength, can be known. Examples like maybe they have sufficient funds if required to invest again and again, sufficient funds. Maybe that's their strength, or management is their strength, good governance is their strength, or employees are skilled, talented, that could be their strength. Resources are abundantly available, that could be their strength. See, the way things are carried out within the organization, which is um, considered as a strength for them, because they are good at that particular aspect. W is weaknesses. Sometimes they may not be good at certain things. Maybe resources, same set of things could be their weakness also. Resources are not abundantly available. Employees are not ethically, morally sound. Management, we do not see that there is good governance there. So there are multiple things internally. Some of them could be their strengths, some of them could be their weaknesses. Assess that, analyze that. After that, look at the external environment. What opportunities are present for them? Maybe there is some support from the government. The relationship with the customer suppliers is very good. See, the demand for them is good, for their products is good, etc. So some of them, they are opportunities. We also see that there may be certain threats. Maybe competition is very severe. Government may be planning to withdraw the subsidies, grants, which it was earlier giving. There could be a possibility of increase in tax rates. Suppliers, with suppliers, the relationship is not fine, etc. Multiple things in the external environment. So assess them as to what are the opportunities and what are the threats that are existing for them in the external environment. Apart from internal analysis, external analysis, there is another analysis called as stakeholder analysis that has to be taken up. What is stakeholder analysis? In connection with stakeholder analysis, there is a model. Little later, we will be learning about that. Who's a stakeholder? Stakeholder is either an individual or a group who is interested in the affairs of the business, because his interest lies with the organization and he would be benefited because of the decisions taken by the organization, or not benefited. So overall, we can say that an individual or a group, if they invest in the organization, we can call them as stakeholders. So what is the expectation of the stakeholders also should be taken into consideration. What do they expect from the organization, etc. So these three types of analysis: internal analysis, external analysis, stakeholder analysis. See what is possible for them to achieve. What are they good at? What are they good at? What are they not good at? See what opportunities are there not present. Opportunities are not present. Threats are present, or the expectation of stakeholders. When once all these things are taken into consideration, what is possible for them to achieve can be understood. So with this, the expected performance can be known. Compare that with the desired performance. If both of them match with each other, no issue. But let's say if they do not match with each other, there is a gap between these two, then this gap has to be closed, because the purpose of its establishing has to be achieved. So if it has to be achieved, then what measures have to be taken to close the gap that exists between the desired performance and the expected performance? I hope I am clear. Are you able to follow me? Are you able to follow me? Provided you're listening to me.
Yes, ma'am.
So what are the strategic choices that are present to close the gap? So gap between these two has to be closed. If that has to be closed, what choices do they have? Strategies are required to close the gap. The competitive strategy for each business unit. Um, see the strategies that are present for them involve either they can take up a competitive strategy, like maybe they can work on their cost and then cost can be controlled, or they can bring about some innovative features into their product, etc. Some way they can have a better hold over their hold on the market. They can do better than the competitors, so some competitive strategy can be adopted. After that, what's the direction for growth? So where should they be investing their amount? Which markets or products should they be investing in? Should they go in for expansion? Whether expansion should be growth should be organic. Organic is on an incremental basis, or they go in for joining with other business partners, joint venture, or acquisitions, take over another business, etc. So these strategic choices, when which are available, when they take up these strategic choices, it becomes then possible for them to close the gap that exists between the desired performance and the expected performance. So then when these things are implemented, give me just 1 second. Now, see the strategic choices which they adopt, like competitive strategy or growth strategy, expansion strategy. When they think about these things, they have to be implemented. So, at the time of implementation, the strategic implementation, we would see that formulation of detailed plans and budgets. Um, they have to decide on in detail plans. The strategic plan includes a very long period of time. Then see, they cannot wait until the end of the period, but for very short periods of time, they can think about preparing plans and then implement those plans. So formulation of detailed plans and budgets have to be taken up. The budgeting part of it, you've been studying from, I mean, right from your graduation time, you've been studying this budgets and budgetary control. So wherever plans are prepared, there are also control measures taken up. So when plans are prepared, planning and control go hand in hand. They have to control their performance, if at all, if it is not according to the plan. So that's important. How do they assess whether their implementation is as per the plan? So that's again important. So formulation of detailed plans and budgets. So set targets for, to measure the performance. There is a concept called as KPIs that are used. What are KPIs? Key performance indicators. With the help of key performance indicators, the performance is measured. Right now, I'm not explaining what is key performance indication, because in a short while we will be studying in detail about CSFs and KPIs. So measure the performance, how they are implementing their plans with the help of KPIs. And if at all, if their performance is not up to the mark, they are not implementing things effectively, then in that case, take all control measures to control the deviation that exists between the actuals and the plans. So that's strategic implementation. The strategic options that are present for them would be, see whether the strategic plan that is prepared, is it acceptable to all the stakeholders? Is it suitable to the purpose of the organization, the basic purpose of the organization? Whatever plan they have prepared, whether this plan is suitable, it goes along with the their purpose of the organization, mission of the organization. Feasibility, the plan that is prepared, is it feasible, possible for them to implement? So these things are looked into. How do they generally understand? See, various types of analysis, then when they are taken up, so it gives an idea about what is the acceptability, suitability, and the feasibility. See, we just now discussed about budgeting and control. So when budgets are prepared, these budgets will become the base. When the actual performance has to be, actual results have to be compared. So actual results are compared with the budgeted budgets that are prepared. If the actuals are on par with the budgets, no issue. But if at all, if there is a deviation, that deviation has to be corrected. Deviation from planned activity, measures have to be taken to correct the deviation. First, the reasons are examined, why there is a deviation, and any kind of corrective action which has to be taken to ensure that the actual implementation is on par with the budgets. Okay, so let's just study what is the meaning of CSFs and KPIs. What are CSFs? Critical success factors. Critical success factors, KPIs, are key performance indicators. See, for the organization to achieve its objective or the purpose, if it has to be achieved, there are certain factors which are crucial. See, for a student to achieve success in the examination, there are certain critical factors like the amount of hard work the student puts in, the resources which are available to the student, how much, how many hours of preparation goes into, how many hours goes into the preparation for the examination, the caliber of the individual student. The multiple factors are there. These factors are important for the success of the students' performance in the examination. We call them as CSFs. Now, these CSFs, mere defining, see, for an organization also, there are multiple CSFs, like there should be profit, they have to make profit, their customer should be satisfied, their relationship with multiple stakeholders should be good, employee should be satisfied, the production, the productivity should be good. See, they have safety measures taken up. There is innovation, there is customization, flexibility, multiple aspects of it. See, these are all factors. If these factors perform well, if these factors do well, then it becomes possible for the organization to achieve whatever is their objective. Okay. So first, it is important to define what are the CSFs. So CSFs are critical success factors. Now, what are they? Critical success factors are the vital areas where things must go right for the business in order for them to achieve their strategic objective. So something has to go well so that they can achieve their strategic objective. After that, see, these CSFs, mere defining the CSFs is not sufficient. So there are multiple CSFs. So after these CSFs are defined, each of these CSFs have to be measured with a suitable related KPI. KPI is key performance indicators. So how is it done? Let's say if we talk about profit, if we talk about sales, if we talk about cost. See, whether cost was whether the sales were increasing year after year, was there any effort to cut down on the cost? What's the amount of profit? Is it increasing over a period of time? Customers, are they satisfied? Customer satisfaction. So how do we measure the customer satisfaction? Was a feedback collected from the customers? Then we see productivity. Was there any improvement? How much of customization did they take up? What efforts were put into ensure quality standards were maintained? Multiple ways, multiple things, and multiple ways in which the multiple KPIs which are used to measure the performance. So CSFs and KPIs, but in between that, there is another important aspect which has to be focused is what are the competencies. See, the organization will need to have in place the core competencies that are required to achieve the CSF. So achieving the CSFs, see, once it is achieved, it is measured with the help of KPIs. But for the organization to achieve its CSFs, there are competencies that are needed. So here in this case, we have 4 competencies. What does it mean by core competency? Those factors which the business alone has, where the competitors cannot match with them. So something which they are good at. So those are called as core competencies. There's another competency called as threshold competency. The threshold competency, if they perform well, then in that case, if they do certain things well, repeatedly, they do well, they can match with the standard of the competitors, but definitely they can never overtake the competitors. So such kind of competencies, if they perform well, if they do well certain things, so then in that case they can be on par with the competitors, but cannot exceed or overtake the competitors. Such competencies are called as threshold competencies. So first define what are the CSFs, define what are their competencies, and measure these CSFs with the help of suitable KPIs. See, this is a simple topic. What is the changed role of what are the changes that have taken place in the role of management accountants? generally if we speak, this is a very small topic, but since you will be answering a case study pattern of examination, okay, almost in every question, more or less the role, the designation that is assigned to you is you are either a management accountant, performance management expert, or some advisor to the CEO, some role where you have to assume, given the question, you have to assume that. So it is kind of similar to the role of a management account. So it is basically you who is doing there. So what changes have taken place? The conventional definition of management accounting is accounting, which is for the management. So the accounting system provides information to the management, and the management, based on that, takes decisions for the entire organization. So accounting for the management is management accounting. The management accountant was also involved in preparation of reports, the past performance, and to some extent also estimate the future. Basically, information was provided to management. Now, in the contemporary scenario, we do not see the management accountant as someone who's providing just accounting information, but rather the expectation is that the the term is now called as a hybrid accountant. The expectation from a management accountant is he should be aware of what is the management structure, what are the technological changes that are taking place, awareness about all these things. So what are the competitive strategies of the competitors and how to face them? Something like the management accountant should be well versed with or aware of multiple things, should be able to do multiple things, well versed with those things. Okay. Um, So why are we basically studying this? Because it is none other than you only. You are taking that role. You are the ones who would be advising the management, preparing reports about multiple things, explanation about various new concepts that are introduced, etc. So put yourself in that place and then understand what is the role of management. There's a term called as integrated reporting. What is integrated reporting? The financial statements that are disclosed. See, the financial statement do not disclose the complete set of information because they are summarized statements, and financial statements have only information in the monetary value. So anything which can be expressed in monetary value is included in the financial statement. Any kind of non-monetary transactions, though how uh, even though they are very important, they're still not present in the financial statements. Like maybe they have signed an MOU with someone, so that's important, that's crucial. So that will definitely have an impact on the organism, but that such information is not provided. Because the monetary value of signing an MOU with some entity cannot be quantified. So we see that there's many things. Then the financial statements are basically in the summarized form. We do not have in detail information about various aspects. So now we also know the stakeholders are all dependent on the disclosure of the financial performance of the organization. So the financial statements do not serve the purpose of providing better information to the stakeholders so that they can take better decisions. Financial statements basically fail. Financial reporting based on the financial statements, they fail to project any such kind of information. But since the stakeholders are interested to know about the affairs of the business, they do seek some information from the organization. So therefore, other details about the organization. is also provided to the stakeholders by integrating other reports with the report on the the reports on other details are prepared, and these reports are integrated with the report on financial statement. Therefore, the concept is called as integrated reporting. It says one report captures the strategic and operational actions of the management in its holistic approach to business and stakeholder well-being. The management accountant works with top management to integrate financial, community, and stakeholder well-being. Then IR brings statutory reporting closer to the management accountant. They act as a bridge because the management accountant has to provide information to the management. See, the information which is present in the financial statements, he would analyze that and then provide to the management so that management can take decisions internally. Other stakeholders are also dependent on the information that is disclosed with financial statement. But sometimes in certain situations, we see that this information is not sufficient. In that case, some other information has to be taken, the analysis has to be prepared, and that information has to be provided. So the other details and the other information which is provided is in the form of, see, all the information, the integrated reporting, the complete set of information is provided in the form of 6 different types of capital. Six different types of capital. We see integrated reporting and capital. The first type of capital is financial, manufactured, intellectual, human, social and relationship, and then finally we have natural. Financial capital, the ones which we record in the financial statements, that's the financial capital. Second, manufactured capital. In simple terms, we can put this one as property, plant, and equipment. So anything which is helpful in the production of the products. Manufactured capital, example, machines, buildings, and tools. Property, plant, equipment. Then the third and fourth are about the human beings, the human resources which the business has, and the intellectual capacity, intellectual ability of these employees. So the third type of capital is intellectual capital. Fourth one is the number of staff, human resources that are present with them. So the details about it, what skills do they possess, etc. So that's human capital. Fifth and sixth, fifth one talks about social and relationship capital. Social and relationship capital as part of that. If at all, if they are, if they have an association with someone else, partnership with some other entity, some other unit, partnership with trade unions and the community. So that's social and relationship capital. Then we see finally the natural capital, which is any kind of resources which they are using, renewable and non-renewable. See, all type of those resources, because now that's connected with sustainability plans. See whether they are taking any efforts in terms of minimizing the consumption of non-renewable resources. So that can be highlighted there. So the sixth type of capital is the natural capital. It talks about both the renewable and the non-renewable resources of the organization. So detailed information about each aspect of it when it is prepared, and then it is integrated with the report on the financial statement. We call that as integrated report. You also must have downloaded the annual reports of some company, so you can see that. If it is generally the financial statements, we would see an income statement, a balance sheet, a cash flow statement, statement of changes in the earnings. It is in the summarized form. But when you download an annual report, you have a very big volume of information provided in the annual report. It is just not about the financial statement. Multiple other details are included in that. So what does it mean? So the information, other type of information which is not earlier included in the financial statements, is now provided by way of integrated reporting. Okay, I think you must have done till here. Did you do benchmarking? Praveen, did you do benchmarking? Please respond. At least you can put a message in the chat box. You there, Afshan?
Yes, ma'am. I'm outside. That's why you're taking.
Okay. Nobody respond. Very difficult for me to also teach. Um, did you do benchmarking? The Praveen is not at all responding. Assuming benchmarking was not done, let me explain. See, for today, in today's class, I will not be taking up any case study, but then in the next class onwards, each class, whenever we have a class, we will solve one case study from the examination kit. So that's in a way we would be preparing for the examination also. So what's benchmarking? What's a benchmark? The process of measuring the performance with the help of benchmarks. Uh, so that process is called as benchmarking. But then what is a benchmark? Something which can be considered as a standard. When we see that um, if one entity has achieved something remarkable, the performance of that entity will be standardized, and the performance of the other organization, other entities will be measured when it is compared with the performance of the standard entity. For example, in a college, if there is a topper, all the topper's performance will become the base. Anybody's performance, if it has to be measured, it would be measured as in comparison with the performance of the standards. So standards performance, the best possible students performance becomes the standard. Later on, everybody's performance will be discussed as in relation to the topper's performance. So that's common thing what we see. Here in case of business also, sometimes when certain entities, when they have achieved something remarkable, that becomes a standard, all the others performance will be compared with the performance of the benchmark or the standard, and then analysis can be taken up.
There are three different types of benchmarks. One is internal, the other one is competitor, third one is process or activity. See, in an organization where there are multiple departments, divisions, among them, if one department or division, if it performs well, then that becomes a benchmark. The performance of that benchmark will become standard. Then the performance of other departments, other entities will be compared with the performance of the benchmark. So based on that, if there any improvements or suggestions can be made, that is made. We can also see that benchmarks also can be selected from among the competitors. See, one competitor who's done well, their performance becomes the standard, and the performance of other competitors will be measured in comparison with the performance of the standard. The third type of benchmark is the process or activity.
See, any process or activity, if it has done something remarkable, then that process or activity becomes a benchmark. See, among the competitors, they may not be ready to share information for comparison, etc. So, any similar process, if they are found in any of the entities which are not in direct competition with the organization, there this comparative comparison about the performance can be done, and the comparison can be done with the performance of the benchmark. So process or activity also could be a benchmark. So we see that internal benchmarking, any one department can be considered as a benchmark. Others' performance can be measured with the benchmark. See, what parameters are used to measure the performance? Let's just look into that. What parameters are used? I'll take class till 3:30. The reason is nobody's responding. Maybe um, others others also will join in the next class so that we can all together proceed further. So I will take it till 3:30. The different levels of benchmark, see, at the strategic level, at the tactical level, that is middle level, and at the operational level, what can be used? Because it's basically comparative analysis, comparison of the performance of individual with the performance of the benchmark. So it's basically comparative analysis. So what variables can be used for comparison? So that is the case. At the strategic level, we see that the market share, return on assets, gross profit margin, these can be taken as the parameters. These can be taken as the variables for so these variables can be taken as the base for comparison. Then at the middle level, we see the way in which they have planned and implemented, percentage deliveries on time, order turnaround time, order cost per order. Then at the operational level, basically, if at all, if there is any variation, because they are the ones who are actually involved in implementation. At the time of implementation, they have to understand about the actual implementation and the benchmarks that are decided. Is there any gap between them? If at all, if there is a gap, and then how to close the gap with some corrective measures. So that's what is those are the variables that are taken to ensure that the
the comparative analysis takes place. Now, how is benchmarking process taken up? So, what's the process of benchmarking? So we are talking about benchmarking as uh, a comparison of the entity with the benchmark. How does it actually happen? So, there is a process involved. This process has 7 steps. So, following these 7 steps, the benchmarking activity can be carried out. So, the first uh, aspect about it is set objectives and decide the areas to benchmark. So, what is that they have to take up? What is the purpose behind comparison? What is the objective behind taking up benchmarking activities? And is it applicable for the entire organization or only one specific activity which is involved for the benchmarking process? First, that's the first step. Set objectives and decide the areas to benchmark. Second one says identify KPIs and drivers. So that's the first one, set objectives and decide the areas to benchmark. After this is decided, see the area where the benchmarking has to happen, or how would I mean, what is the purpose behind that if it is decided? Maybe it is about cost control, maybe it is about maximizing the profit, it is about their activities, their deliveries, the productivity, the customer satisfaction, multiple areas where they can measure the performance. So once the areas of benchmarking is decided, they have to decide on the KPIs and the drivers. How would they measure? The measurement of performance which is related to the actual activity that takes place in the organization. So maybe let's say if it is cost control. So department wise, activity wise, how much cost is incurred and how much of that activity was specifically related to particular entity. So identify KPIs and the drivers, the usage of a particular variable. So KPIs and drivers. Then we see the third one is um, this benchmarking activity is between and among which business partners, that also has to be decided. Among these things, which one is a benchmark and which other entities the performance has to be compared. Select organizations partners for benchmarking. Then and until that point of time, what is their performance that has to be measured? Measure performance of all organizations partners involved in benchmarking. Then we see the performance now has to be compared. On comparison, then we identify what whether they are on par or not. In that case, some suggestions can be made, some improvement um, projects that can be specified has to be taken up. See, on comparison, the comparative analysis identifies what are the weak areas, therefore specify improvement projects. As the implement the improvements, then implement and monitor improvements. So that's the process of benchmarking. The next class, today's class, so very less, only two are there. Among them, only one is responding on and off. So I will not start a case study right away, but definitely I will do this case study in the next class. Just now I was explaining to you about SWOT analysis, the internal environment, understand what are the strengths and weaknesses in the external environment. The opportunities and threats that are present to them has to be looked into. The internal strengths and weaknesses relate to resources and competencies. What are they good at? What are they not good at? Um, are the resources abundantly available, or is there any shortage of those resources, etc.? So multiple aspects. What are they good at? What are they not good at? Identify. In terms of resources, in terms of um, the employees, the skills, the resources like capital, etc., technological advancements, etc. So they are either their skills, the strengths, or they are their weaknesses. And in the external environment, we see that there are opportunities present and there are threats also present for them. So how do they explore them? So some of the examples given here are: how will economic change impact the organization? Can the organization make use of the new technologies? If the if it is a new business, um, then will it be possible for the new business to enter into the market from the existing um, stakeholders point of view? Of course, we will discuss this and new entrants, the threat of new entrants to the existing business, how do they face it, etc. In the model called as Porter's 5 forces. So the first force is the threat from the external, sorry, threat from the new entrants. So in the external environment, when new entrant is trying to enter into the market, so what kind of threat, or is there any opportunity present for them? So basically in the external environment, all those things that are present for them, the opportunities that are present, the threats that exist in the external environment has to be clearly understood. Okay, that's SWOT analysis. This is one model I will explain in today's class, and then we can wind it up. The working out of the questions, etc., we can take it up from the next class onwards. See, when strategic plans are prepared, there are multiple things which have to be learned. So one among them is Boston Consulting Group matrix. The Boston Consulting Group BCG matrix is basically helpful in measuring the performance and categorizing them into 4 different quadrants. There are 2 variables that are taken. One variable horizontally, we see that it is market share. Another variable vertically is the market growth. If it is market share is either high or low. On the extreme left side, we see on the left side of this particular matrix, horizontally left side, it is high. Market share indicates how many customers did they capture. So how many of them are their loyal customers who buy from them. Okay. Um, the market share on the left side it is high, on the right side it is low, which means that as of now they have captured a very good amount of market. Then it can be called as high. Until now they have not captured the market. They do not have good customer base. They have not sell their products to many customers, etc. So that can be categorized as low. The vertical thing is market growth. Market growth here we see it is high and low. What does it indicate? It indicates that, see, for the market is the industry where they the market, it has a scope to grow. So when it grows, it also projects a possibility or a growth for the individual business. So if that growth has to be achieved by an individual firm, there is something which is required by the firm. So the firm also, to grow along with the growth of the market, it has to invest additional funds in the business. The growth just does not happen automatically. To grow along with the growth of the market, they have to go in for additional investment. So certain cash balances or cash reserves have to be utilized or invested into the business for them to achieve this growth. High growth or low growth talks about the future possibility for them to grow, the scope for them to grow. Because the market is growing, it becomes possible for them also to grow along the market. So that is the concept here. Now, in a combination format, when the market share is high and the market growth is also high, as of now, they have, see, market share talks about their present performance. As of now, they have achieved high market share. There is also a possibility for them to grow in the future. So, present it is good, future also seems to be good. So, the combination of these two, okay, high market share and high market growth, it talks about uh, the category, they would be categorized into a star category. So they would be falling into a quadrant which wherein it is named as star. So they can be considered as stars, high achievers, possibility to grow in the future as well. Then we see that if the market share is low, which means that as of now they have not achieved something remarkable, they still have not attracted many customers, it's on the lower side. But the market, as the market grows, it has it leaves a scope for the individual entity also. So based on that, because the market, it is possible to grow, so it's possible to grow for the individual firm also. In that case, they are categorized as problem child. Now, no performance, but future seems to be bright. The third category is, as of now, their customer base is good. They have captured the market very well, but there is no scope for them to do well in the future. Market growth is not possibility. The reason for that is basically maybe in their product life cycle, they must have reached the maturity level beyond which there is no more scope for them to grow further. So if they have reached that stage, then there is no scope for them to grow in the future. So present performance is very good, high market share. So that would be generating cash flows for them. But future is not attractive. So future is not bright, it's gloomy. So we can call that as cash cows. But because they've already captured the market, they have high market share, they can, that would be generating cash flows for them. But then future is not bright for them. So fourth category, we see that the individual firm or business unit has not achieved anything, their market share is low. At the same time, there is no scope for them to grow in the future as well, because the market also has reached to the stage where there is no growth possibility present for them. So then they are categorized as dogs. This category of dog indicates that the business unit should be shut down. Like dogs are abandoned, so these kind of business units should be, it should be thought about shutting down of those businesses, because there's no performance as of now, no scope for them to do well, perform well in the future as well. So it's what can be taken up, but what can be thought about, that is it's better that that is shut down. The cash cows are generating good cash flows, but because they have already reached that maturity point, there is no more scope for them to do well beyond that. So that is the time when they can think about divestments, withdraw their funds and invest in some other business. So cash cows, very soon they will touch that decline. So it is better that they think about divestment and invest elsewhere. Problem child, why are we calling it as a problem child? There's another term which is called as question mark, problem child or question mark. See, as of now, their achievement is on the lower side. But because there is scope for them to do well in the future, they should capture on that, grow along with the growth of the market. Along with the market, they should also perform and then grow. If they cannot grow with the market, then their future scope also will come onto the lower side. So present it is low, future also if it is low, then problem child will move into the dog category. What is done with dog category? They are generally considered for shutting down of the business. So problem child, it's called a question mark or a problem child because see it can move into if they perform well, it would be moved into star category. If they do not perform well, it falls into dog category. So it's a question mark. It is all based on their performance. It's a question mark about whether they can achieve this or this. Stars also, as of now, they are performing well. But in future, if they do not perform well, they do not grow along with that, or the growth also comes to that stagnation point, in that case, stars can fall into cash cow category. Okay, that's how there is a model which is given and explained, which talks about the performance of the business units and how they can be categorized into these four quadrants. Is that clear? Afshan, Praveen, is that clear?
Yes, ma'am.
Yeah. So we'll do one thing. We'll wind it up because I mean, only two of you are there. Not much response also is there. What we'll do, we'll continue in the next class. Maybe many will join. So next class onwards, we will each class we will work out one case study and then proceed further. So if at all, even if you have missed, I don't think anything beyond this the other classmates must have done. So all of you are on par. So the next class when we meet, we can continue from here. And then for each topic, maybe starting from benchmarking, uh, for each topic, we will take up one case study and then proceed further. Okay. Any doubts on what
Okay.
you've learned?
No, ma'am.
Praveen is not at all responding. Done. So I am wind up the session here, and then we can meet whenever is the next class. I'm not sure about the schedule, but whenever is the next class, we'll meet on that. Okay.
Okay, ma'am. Thank you, ma'am. Bye.